7 or 8 times out of 10, business owners are probably not the right people to be a GM or an operations manager. Getting time back in the owner's day to focus on what they're actually good at, which most owners, I find, are good at selling their product or service. At a $50 million turnover, changing your GP by 1 or 2% will pay for that and more. And that's just one line item.
Taking a business from a couple of million turnover to 50, 100 million turnover. Can you spot 3 things that make or break that journey?
What I would put at the top of the list, it's people. As a business grows, it needs accounting software, an ERP system. You need people to implement it, you need people to run it. And at some point, at these types of sizes, you can't be at the coalface of every single decision.
How do you get over, as an owner, the trust issue?
And the answer is go.
Yeah, okay.
I think then pulling apart the business from a numbers side is then important. Is this product profitable? Is this customer profitable? Is this geography profitable? Most businesses that do grow before they do get support, they will grow for the sake of growth and they will not grow profitably. But you've taken all this extra risk.
If you're in business and you're not thinking of selling, should you care about the value of your business?
Yes, reporting, technology, people, governance, all of that, if done well, will result in profit. And I don't need to tell you this because this is your area of expertise, but the more profit or EBITDA that you have, that you achieve consistently over time, it increases your multiple. That's your value.
When should I get advice on tax?
Yesterday.
Oh my God.
Having a conversation with your accountant or advisor about planning for these things, you can never lose anything. This podcast is probably a really good body of work to go. If you haven't spoken to your accountant or an advisor about these types of issues, they might not be fit for purpose for the scale and risk that you're taking on. But some other telltale signs are...
Welcome back to Let's Talk Business. Today our guest is going to help us unpack the journey from a business of a couple of $1 million turnover towards the $100 million turnover journey, and what are the success factors, risks and issues that he's found in working with clients in that space. He works for international business services firm KPMG, and he's a director in the accountancy and advisory team. Luke Grima, thanks for joining us.
Thank you, James.
Yeah.
Appreciate you having me. Thank you.
Yeah, it's lovely
Pleasure.
to have you. Hey?
Thank you.
You're in the hot seat, right? Because the mid-market, those are clients that are going through that journey. Tell us a bit about your role and what you find.
I think at the core, what we do is clients will come to us for preparation of their financial statements and their ongoing tax compliance as the kind of bread and butter services, so to speak.
Yeah,
but I think where we're different is just having that really strong commercial view and not putting tax and accounting first, but actually putting the commercialities of things first.
Yeah.
And I would probably say as a skill set, our team, we're probably, we know what we need to know about taxes and accounting, obviously, but like our real skill set is on the commercial side of things and helping clients make decisions that are, of more value or more importance to them. So, some good examples are if there's a transaction coming up, for example, a property purchase, how do they do that to couple in with their business? Buying and selling businesses or units in businesses always comes up. And the due diligence work around that at times, to even something as simple as, say it's a restaurant business or some type of retail business that's going to look at a new location, we'll support with the lease. What are some things in a lease that might trip them up that from an accounting and tax perspective, but also a general commercial perspective as well.
So Luke, right at the outset, if you think of that journey from taking a business from a couple of million turnover to 50, 100 million turnover, can you spot sort of, and every business is different, right? But can you spot 3 things that make or break that journey from your experience in seeing clients go through it and helping them go through it?
There's probably more than 3, but probably what I would put at the top of the list, which is probably not the typical answer you'll get from an accountant.
Yeah, right.
It's people.
People.
It's people. Yeah, it's people. You, as a business grows, it needs grow, and that might encompass an accounting software, an ERP system. It might encompass what your HR function, your sales function, your marketing approach, your sales distribution channel. But the technology that you actually use in your business. But even with technology, if you stop and actually think about it, people is all at the heart of it. You need people to implement it. You need people to run it.
Yeah, right.
And at some point, at these types of sizes where your revenue is at $100 million, as an owner, you can't be at the coalface of every single decision.
No.
So you need to be trusting people to be making good decisions on behalf of the business, no matter what, department or what they're contributing to the business, or whatever it is that is contributing to the business. People will always be at the heart of it. And so finding the right people as the business grows, preferably before issues arise, is probably the number one thing I would say.
That's really interesting, right? So you're an accountant, you're a dry accountant, a numbers person, eh? And you just said, oh no, it's human flesh. That's what it's all about.
Yeah.
Right?
It is. Like if I, to dig a little bit deeper, if I think about, for example, a recent client experience in the last couple of years, a real stock inventory based business, real heavy in stock and inventory, into the construction sector, grew pretty rapidly, and what naturally happens with these businesses, particularly where they're a little bit averse to debt, is they'll just basically grab their cash profits that they've made over the years and buy a whole bunch of stock, and probably plant and equipment and stuff around their premises to be able to service and sell that stock. When you grow to that size and your volume is that high, your risk literally is tied to how well can you sell this stock, and at what margin can you sell this stock? And at 100 million in turnover, you're not looking at every piece of item that you're selling. You need people to do that. And so, seen businesses that to get into the finance function, for example, you really need, obviously being an accountant, we see that, you've got to get your finance function right. It needs to be reporting numbers into you timely, so you can make good decisions around the business, around funding the business moving forward, around how much profit you take out, around where you invest further into the business. And if you don't have a good function, if you don't have the systems to report into, if you can't capture your inventory or stock at any point in time, if you don't know what your margins are on each piece of material that you sell, how can you be making good decisions? But if you stop and think about it, it's still people at the front of that, right? The owner is normally good at selling or operating the business. They're not normally a numbers person, but in the mid-market, that's what we normally see. So who's going to be the person that leads that for you? So it is still people.
So are these businesses very owner dependent? The ones that are, 50, 100 million
I think
turnover?
As they start on their journey, they do become, but the more successful ones and I think the more valuable ones over time are the ones that become less dependent on people and more dependent on a process that involves people, but the people can be interchangeable.
Yeah, okay. But let's go back to the people issue. You cited it as one of the key elements of success in moving through that journey. Do owners that found the business, that are going through that journey, do they always... Do they learn by hard-won experience that that's the issue? Or and what's stopping them grabbing good people along the way?
Yeah. I like to use the term, again, in the mid-market, it happens all the time. You don't know what you don't know. And as an owner, you would have operated at a $5 million turnover, $10 million turnover business, and maybe you made a 10-20% profit margin, which is a lot of money for people in the mid-market. That's great. But when you scale up, it's a very different operation, and things are very different. And so the owners typically know how to run a $5 to $10 million turnover because they can wear multiple hats and they're taking less risk in the process. But as you grow, more issues arise. You're probably not well equipped or as well equipped to run a $50 million turnover business by comparison to a $5 million turnover business.
Why do you think?
Simply, James, because it hasn't happened before. The owners, they've been in business. They've never run a $50 million business. They don't know what are the issues that are presented to a $50 million business. So I think where good decisions get made along the way is at the right time, preferably before something goes wrong, you're bringing in people to take over on a department. And I think my personal opinion is probably 7 or 8 times out of 10, most business owners are probably not the right people to be a GM or an operations manager of the business. They're better off probably putting someone into that role who reports into them as a shareholder or a managing director or whatever title you want to call it. But I feel like bringing someone in external to the business with commercial expertise in that role, they'll know what a good sales function looks like. They'll know how to interact with that. They'll know what a good operations process looks like. They'll probably know what technology needs to go into that to support the business, and so on and so forth in each department. So it's just commercial experience. And I think bringing that external commercial experience into a family business is so important for the evolution of that business. Another barrier to sort of answer your question a bit more directly around why, apart from, don't know what you don't know, it is hard for the owners to realize that. But once they are made aware of this, whether it's good advisors around them, or they might have some good contacts in the industry that can support.
Or it's, in fact, mistakes they've made that
Correct.
see the business deteriorating, right?
Preferably not. But the next barrier often becomes cost. These people probably come with a price tag, and there is a hesitation to commit to that price tag. And it is actually hard to see the return on that because that person's not in a sales function.
So let's put some figures around that, Mr. Accountant.
Okay.
So, for instance,
you
know, I'm a founder of a business. It's a $10 million business that's getting 20% at the bottom line.
Yeah.
I've been running it. I've been taking $100,000 a year in wages, and then everything else, I pay myself in dividends at the end. I go to market because, someone said I should have a general manager because the business is growing rapidly and I can't do everything. That general manager in market, it's probably a package of $300,000.
Call it.
Yeah. And I look at that and I think, my God, I haven't been paying myself that, and I'm taking all the risk.
Yeah.
Is that the tricky dynamic?
Absolutely. Yeah, absolutely. But what's hard for the owners to see is that 300 at a $50 million turnover, changing your GP by 1 or 2% will pay for that and more.
Yeah.
Right?
Okay.
And that's just one line item, right?
Yes.
They might have better ideas as to how to increase revenue, or make it more profitable through GP. There might be some fat in the business in, say, overhead labor costs that, too top heavy in terms of people. We need less people, or these types of expenses are not required in our business, or they can be restructured into a particular different way. And so, there's plenty of levers that can be pulled through that person's commercial experience that'll pay back for their wage and more. And the other thing too around it is like that the financial metrics is just one component. It's probably the most important for owners, but getting time back in the owner's day to focus on what they're actually good at, which most owners I find are good at selling their product or service. Okay. And so naturally, you put a GM in to sort of more run the business. The owner is able to focus properly on sales. How can they find better relationships in market? Win work or sell product in a different way, and really properly focus on it. Because as an owner, you're actually wearing two hats at that point: the owner hat and then your employment hat, which, if in this particular example, is sales. And if you're not doing your job well as the owner, it's then from a dynamics perspective very hard to implement positive change.
Interesting. How do you get over as an owner the trust issue? Because like the numbers and the commerciality of what we've worked through makes sense to me, but there's still that a bit of inertia. If I'm taking the risk, I've worked on it hard, I'm counting on it. The business helps me fund my habits around my property investments. If this was to all go wrong, things are getting out of my control. They're growing fast. Is that, do you often have those exchanges with owners?
Absolutely. Absolutely. And the answer to that, burning question issue that always arises is governance.
Yeah. Okay.
Governance is a fancy, fluffy word at times around, who knows what. But I think what it means at the core is accountability, right?
Yeah. Okay.
Accountability.
Okay.
And so my question to clients at that point is, what framework are we going to put in place, or what processes are we going to put in place to keep everyone accountable?
Yes. Not
just the GM to the owner in said scenario, right? So a really good way that I see that happen with clients is through meetings or advisory based or board based meetings. They don't need to be formal board meetings per se.
Yes.
Where all of the key people in the business are getting around the table for a couple of hours at least, so it's not rushed. Yeah. And each department, I guess, is reporting into the board or the people that are present around what's happening in their team, their struggles, their support that they'll need from other people in the business. Finance is kind of key to that because everything is underpinned by numbers, and obviously there is a bit of sensitivity to work through around the numbers in the business. But I feel like, and I'm a big advocate of transparency across your key people in the numbers is really important to get performance or for people to perform. How can your procurement manager or your purchasing manager do their job properly if they're not across the GP and what that GP does to the net profit.
Yeah.
How it's not possible.
Yeah.
Or it is, but it's not going to be as efficient and as effective as it possibly could be. So I think getting around a table regularly where people, action items, people are held to account on what they said they were going to deliver, reporting and metrics, and in that forum, those numbers are reported on, or the metrics are measured.
Yes.
So people know in front of, the owner and in front of other department heads that they're either doing really well or they're not. And I think that in itself drives accountability.
So interesting. At the top, we talked about what are the success factors of going through that journey to growing up from, a few million turnover to 100 million turnover. And you said people. Then you just dropped the whole governance accountability piece as being key to make those people, effective in their roles.
Yep.
And I guess the other aspect that you've talked to us about is the systems and reporting that provides transparency that underpins the accountability and governance,
yes.
right?
Yep.
So, I can kind of see a grouping of key things there that are probably relevant no matter what the business is.
Absolutely. Yeah, absolutely. And I think, back to what I said at the start, all of that is centered around people.
Yeah.
It's all still people, and it's interesting in a world where technology is coming through, and I think it's got so much potential and can impact businesses in such a positive way, and it needs to be at the forefront of people's minds, but we cannot lose sight of the impact of people in our business. And I think people will always need to be ahead of tech. Always.
So it's interesting because if I talk to a number of business clients, often their biggest pain point is getting the right people and keeping them. And you're saying it's the biggest success factor in growing your business from X to Y.
Yeah.
So I mean, clearly accountability and governance and discipline and having reporting systems is one foundation around ensuring that people stay on track within the business. But are there any other key sort of tips that you might mention to business owners in identifying the right people for their business?
That is hard.
Mm-hmm.
I don't think there's a simple one-stop sort of answer to that.
No.
But often those people exist within the business already.
Oh, that's interesting.
Yeah, often. And it's just about giving them room and empowering them to step into a role. Giving them responsibility. Like if I think about my journey in my career, I thrived the most when I felt like I was responsible for said client or said task, as opposed to just being a cog in a wheel to report into the next person or the next kind of, next part of the supply chain. So I think giving people responsibility can change the way they operate.
Yes.
But I think, externally, it is hard. And I think right now, particularly the way the labour market is at the moment, it is so hard to find people. So I fully acknowledge and appreciate that, this notion of centering, growth around people, making it sound very easy, but there's a reason why a lot of businesses don't do it very well, and it is because it is hard to find the right people, especially right now today in the current climate. So unfortunately, there's no real easy answer. I think, you probably need to be willing to make some mistakes along the way. I know we have as a business. You hire, and I've seen clients do it as well. Like you hire people thinking that they'll do something really, really well, and it just doesn't work out, right? I think you need to be willing to own and work with that mistake, and it will cost you money. But if you do find that right person and you can retain them and attract them to stay for a long period of time, what they will bring to the business financially and non-financially in year 1 or year 0.5 will cover the cost of the mistake you would have made to get there.
So persistence is important. Patience is important. And look in your own garden first, because you might have a gem sitting there, but you might just need to look at them in a different way and give them a bit of room to grow. Yeah.
And also in the hiring process, sorry, James, like don't feel like you have to be the person making every single decision along the way. Like a simple example, an easy one for me to articulate. If you're going to hire a finance manager or a CFO, get your external accountant involved if you're confident in their capabilities of assessing someone in their role.
Yeah, that's interesting.
Yeah, if you're going to hire a salesperson, get the sales manager to lead it. Or if you don't have that person in your business, like reach out to other people in your network to support you in that. I think people need to try and be vulnerable and open to knowing, I'm not the best person to ask the right questions to gauge if this person, is talking rubbish in the interview or not, and to call them out, with the right questioning in interviews. Whereas if you can lean on people around you to do it, why not?
Oh, I like that.
Yeah.
So phone a friend and involve them in the process.
Absolutely.
Right? Yeah.
So don't feel like you have to be the chief decision maker and have to lead the process on your own from start to finish as the owner.
I want to round off a little bit on the people thing, although, I could see that, you're sold on that fact, and it's really interesting that you've drifted in early in this discussion, because I think it's exciting to see how sort of numbers and people come together to make something good. My last podcast, Simon Millett, one of the things that he said was key in growing that business was retaining his staff.
Yep.
And they came up with a bunch of incentives and ownership opportunities.
Yep.
In that area, reflecting on growing your business through that journey in the mid-market, what advice would you have to clients?
To be very careful, but open to it. Okay. So I think those types of incentives are really key around attracting staff, because a lot of staff will become really good in their role and they think, well, I can go in business and do this myself and be more profitable, which they're well within their rights to think and do, right? So how do you keep them?
Yeah.
Equity, so giving them a share in the business is obviously one, but I've seen it in many examples go really wrong.
Okay.
And it can really affect the culture of the business, the dynamics of the owners.
Is that because of sorry to talk over you, is that because of a them and us issue? In other words, some people have got equity like the owners, others haven't, or is it
sometimes?
It's
sometimes the expectations of one another as co-owners with, say, different percentage of ownership can change, and I might expect something from you as a co-owner that's different from what you expect from yourself towards me, and then vice versa. And the conflict can arise at that point. And what's interesting is you throw a family dynamic into all of that, where, say, you've got siblings, shareholders, and a third person. It's not a family member comes in, then the dynamic can change.
Yes,
that's just one example. There's plenty of some people can feel a sense of entitlement as a result, and because they're an owner, they neglect their employment role. Just that concept of what hat do you wear in a business?
Yes.
Even like I actually talk to clients around. There's actually 3 hats that often are worn in businesses. There's the employment hat. There's a director hat, and an owner hat, and they're all very different and all have different responsibilities, different risks, and different rewards. And when you blur the lines as an owner with the other 2 hats, problems can arise. So I think equity is generally speaking it can work. I'm not saying it can't work in the mid-market, but you've got to really manage the risks around it really well, and often it is just around dynamics.
Okay, so I mean, I want to tease that out a bit further.
Please.
But before I do, in the mid-market, growing to a multi-million-dollar business, these 3 hats you mentioned,
yes,
employee, director, owner, do they become more significant to focus on for everyone, the founders, the owners, the employees?
The bigger you get, absolutely. Yeah, definitely. Yeah. So an employee, you're paid to perform a role and achieve an outcome. That's pretty simple. I think director's the one that gets forgotten a lot.
Yes.
It's not good to be a director, particularly in Australia.
Because of the responsibilities under ASIC and the risk.
Correct. Yeah. There is a lot of scrutiny, and it's increasing as time goes on.
Yes.
Directors can be accessed on a lot of taxes that are unpaid. They can be accessed for work health and safety matters where there's a view formed by the regulator that you haven't put the right processes and procedures in place from a safety perspective. Employment law is something that's
a whole nother bag of frogs.
Yep. And it's all, the responsibility all falls on the director if if things aren't in place as they should be. And this whole concept of the corporate veil that used to exist, it still does, but it is diminishing over time. So people think, I'm a director, it's great, but it's not. Really, because you're taking on all the risk, and often the owners are the directors, which naturally I think makes a lot of sense.
Yes.
But you should be paid quite handsomely for taking on that risk, right?
Yes.
And so owners will often do that by way of dividends and the like in terms of how they operate their business. But yeah, director, you are responsible for the operations and the financial financial outcomes of the business, because stakeholders, are relying on you as a business to be financially sound and solvent, whether it's government, whether it's employees, whether it's the shareholders who can be separate from the directors, regulators, the community around that business, suppliers, customers, of course.
So it's a serious role. Right?
So it's a role, and it's a responsibility above all else. And then the third is the owner. Okay, and the owner has an expectation to get value out of the business in some way, shape, or form, be it dividends, be it equity at the end, market value. And you're engaging the directors to steer the ship of the business. Now, often in family businesses, they are one and the same. And because they are one and the same throughout those three hats, things get blurred, roles get blurred. And so you might attend one of these governance meetings. What hat are you wearing? Are you wearing if you're head of sales as the owner, are you wearing your sales hat? Are you wearing a director hat because you're responsible for everything? Or are you wearing the owner's hat where you're wanting to extract as much value off the table out of everyone in the room as possible?
So that's really tricky, right? Like, as an owner, do you have to be like a Jekyll and Hyde? Because, there's some conflicting issues, right? On the one side, as an owner and a shareholder, you might need those dividends to fund your broader portfolio. But on the other side, as a director, the solvency of the business is an absolute key responsibility.
Huge.
So those two, sometimes they're going to crack, right?
Hence, people, right?
Okay.
So you're going to this meeting, you're not wearing three hats. At a large level, this conflict of interest as you're referencing, it's so risky at $100 million, $200 million in turnover. Depending on if you're in construction, even more so, because there's more risks inherently in that business. So that's where, for example, a GM, they might wear the director's hat, for example. Or if they don't, part of their roles and responsibilities are akin to what a director might be. So you're coming into the meeting as an owner where that general manager who has those roles and responsibilities is reporting into you on that. Whereas if that's you, that can often not work. And then you can extend that out to the employee role as well. So people, and having good people in those roles to separate and segregate those duties.
Yeah, no, that's fascinating. And really important. There's a bit of complexity there, right? Because it requires an owner to, almost be looking down on themselves and saying, "No, listen, what hat are you wearing today? And are you true to your hat, so to speak?"
And everyone's so busy in your role and in family life, it just doesn't work.
Yeah, interesting. And just going back to the retention and the prospect of giving, senior employees equity, for instance.
Yes.
So there are other options that you would consider that perhaps are not necessarily ownership, but might achieve the same thing.
I think so. Yeah, I think most, if you boil it down, and I don't think there's anything to shy away from this. What motivates people most is money, and a financial outcome. And so I think in the first instance, and I think I always tease this out and challenge clients on this when we do have an equity conversation for staff. If what is it that's motivating the employee, and if it is money at the top of that list, then a profit share arrangement might be more appropriate for that business, because you're then not getting into the ownership and equity pitfalls that we were discussing earlier.
Yes.
And you can give employees a lot of comfort around that being formally in place through just a simple agreement. Documenting it in writing will give the employee comfort that you're being fair income about the arrangement.
Yes.
And there's plenty of ways that you can draw it up. It can be based on net profit. It can be based on gross profit. It can be based on top line sales, which I think is a bit risky. I think,
Why is it risky?
because revenue for the sake of revenue is not. It's actually, you're taking on more risk for zero reward if it's revenue for the sake of revenue. So it needs to be profitable revenue to be worth it.
Yeah.
So I think I'm more inclined to tie a profit share on profit as
Get
opposed
it.
to on revenue. So
Some owners don't like sharing their profit line though with the team. Right?
No. But I think.
What do you think about that?
I think I understand it, but I think particularly in this day and age, if you want to really attract and retain staff, you need to incentivize everybody in the business in the right way.
Yeah.
And if you're not, you will lose people.
Yeah.
You will lose people.
And I guess it sort of underlines your other point about having the systems to measure profit or return sufficiently so that it's robust enough to actually pay a incentive on it.
Yeah, of course. Yeah, definitely. Yeah. Still people at the front of that though.
Yeah, no, I love it. But we talked about profit. Sales for no profit. I hear a lot of people, and at the outset we talked about this is all about growing a business from a few $1 million to 50 or $100 million and beyond. But that's sales. Do you find that a few clients go on that journey and they end up growing sales rapidly, but they don't actually get the profit? In fact, it diminishes. What are the factors you see around that? And how do we, as business people, how do we avoid that scenario?
Yeah. People. Not to harp on about it, but it does happen a lot. I would almost say that most businesses that do grow, particularly in that initial period, before they do get support, they will grow for the sake of growth, and they will not grow profitably.
Wow.
Because they don't know what's required. So take a $5 million business that grows to a $50 million business, and let's just say they're in a stock-based industry where they have to
sell inventory regularly.
Yeah, but they might maybe even think about a manufacturing business. They have to manufacture. So they've got to bring the raw materials in, manufacture it. They've got a finished good, and they might need to then distribute that finished good to the customer.
Yep.
If you've got $5 million worth of sales, think about how different that process that I just described is when it's tenfold. Okay, think of how many more people you need. Think about how much more raw material you need and the costs associated with bringing that in before you've been paid on that.
Yeah.
Think about the extra risk that you're taking in that, whether it's staff in a warehouse injuring themselves, whether it's fluctuations in the economy. So you can sell said product for $100, but the market shifts and you've bought all this stock and you can only sell it for $70. That's your profit, probably all of it gone and some.
Yes.
There's what other types? There's
potentially quality and obsolescence, although
correct. Back to the people thing. If you've got $5 million product that you're keeping on top of the quality, when it's $50 million, how can you do that?
Yes.
As an owner, can you have your eyes on every single process in the chain? So it's just not possible. It's just not possible. No. So you'll have issues along the way in terms of growing that revenue, and all of that will result in your profit not necessarily increasing. Yeah. But you've taken all this extra risk in doing it. And if you're just going to keep doing that, it's like take the business out of the equation for a second. It'll need more of your time, and you've got outside commitments from your business. You've probably got a family. You've got social commitments. You've got everything else. Your health, putting a time aside for your health, and all of that will be sacrificed because of it. So, growth isn't always good. Most of the time it is, but it needs to be done in the right way to make sure it is worth it. Otherwise, if you're going to be pulling out the same amount of money you did as a $5 million business, you're probably better off for your mental health and your own, your own well-being to go and just work for someone and earn the same amount of money without the stress.
Yeah. So a lower turnover business, but you might have the same profit, potentially. If you want to grow and you also want to retain the profit, you got to get good people to help you with that. That's a given from this discussion. But are there other things that sort of future-proof that? That you could point to?
Yeah. I think technology. Technology, and technology will have the ability to capture data really, really well. And that can be non-financial data as well, right? So it could be, customer behavior and trends.
Yes.
So if you're a hospitality business, data is so important. What are your customers doing? What are their preferences in your menu? Particularly if you've got a group of venues and they're attending multiple, you can sort of understand their habits and you can market and position yourself to them in a much better way. So data, and then there's the financial component to data, which is how we're performing live. Like you want to know your numbers live so you can pivot and make decisions quickly to the betterment of the business.
Do you find that these businesses go through a period where their finance team, and I say this in an endearing way, are well-experienced bookkeepers?
Yep.
And they need to be more than that.
Yeah.
Because the business grows very, very quickly.
Absolutely.
What do you see?
Yeah, it does happen regularly. And I think the finance team that were in the business before it grew, they've certainly got an important role to play as the business grows and when it becomes mature, right? Yeah. So I don't think we're here to sort of say you need to change the people in your business, but you need to change the people. And what I mean by that is change how they operate, not change them physically, if that makes sense.
Yeah.
And so part of that, again, is bringing in other people to change the function. Okay. And often it is at the top. So if you're a smaller business and you only really needed bookkeepers, for example, or accountants, continuing to have them in the role to evolve is so important because I think they've got the history of the business, they know how things get done, and they can overlay any changes with how things are presently to make that a more smoother process. But bringing in someone with external commercial experience that knows how it should look and feel and operate and report into owners is probably the best way to do it. And that person then can lead the function with the existing team around them who have the history. So I think, forecasting, budgeting, cash flow is important. Technology change. So I think people that come into the business with external experience and expertise will know what technology should be used in a finance function to capture data, to report, etc., and be able to implement it.
Yes.
I think even people management, right? I know I keep harping on the fact, but if you think about any manager in any department, not just finance, they need to know how to manage people and relate to people and lead. And so a finance manager, a financial controller, a CFO will have the ability to do that. They'll have the soft skills that people still be able to manage people because they're still a department head at the end of the day. So they have to manage people. So even that in itself is super valuable. They've then got to sit at the table with other experienced people in the business to tell them, no, what you're suggesting actually doesn't work because it has X, Y, Z impact on the finances. And so having that, I guess, clout as the lead of the function is also super important. Like you might need to tell the owner of the business that they're wrong.
Yeah, interesting. And that would be an interesting discussion, right? But you're suggesting that it needs to be as transparent as that. An example of that, you're wondering whether we still use the term management accounting. But think about margins.
Yeah.
The finance function, are they the people that need to look at the customer base, the client base, and say, well, we're getting this margin from this client and that margin from this client. And the last 6 months, our margins declined by X.
Yep.
And you're wanting to sign up these, Mr. Salesperson, you're wanting to sign up these tenders, and really, it's revenue for revenue's sake. Why are you doing this? Is that the kind of...
Yes. That was probably the next thing I was going to say around...
Right.
Yeah. Like, I think then pulling apart the business from a numbers side is then important. So is this product profitable? Is this customer profitable? Is this geography profitable? I work with a food distribution business, and there's been a new CFO that's come into the role in the last 6 to 9 months, and immediately I can see the difference that they are making with regards to those types of things. They're pulling customer margins apart and going, okay, this customer's margin is only at this percentage, which is low, and the volume that they're spending with us is low. Why are we servicing this customer?
Yes.
I can tolerate a low margin if their revenue is significant to us.
Yeah.
And so that's probably the first and most simple element. They then look at product SKUs. They then look at he's then already started to look at the run. So the truck is doing this. I don't know. Say they're going into a Shire, for example.
Yeah, and it's delivering to X,
Is
Y,
this
Z.
a profitable run? Can we do this in a different way? That's the true value. And so when I talk about spending money on these types of people, if you can increase customer margin, increase the efficiency in which you deliver to these customers, get rid of products and simplify your warehousing so that you can save probably overheads there and costs there, at a $50 million turnover, that's going to, their salary increase to what was there previously is going to be peanuts.
So that's going to help a GM or an owner in that role, because it's giving them the intelligence to help make some business decisions, right? It's not just managing the flow of money here and there.
Don't know what you don't know.
No, well, yeah, and I think you said that to us up front. So it's getting that expertise.
Yep.
We talked about growth for growth's sake without profit before. The businesses that go on that journey and learn the hard way, in other words, build a whole bunch of overheads and diminish profit as a percentage of revenue. Is it that they pull the lever on growth too quickly before they've got some of these core elements like people and systems and accountabilities in place? Do you think? Is that typically how it
I think
works?
so, and I think so, and I think it's just a case of growth can be sexy. I run a $50 million business versus a $5 million business, and I think we can get caught up in what's required to service a $50 million turnover business.
Yeah.
And again, not knowing what's required in each department and each process that delivers the revenue at that size and sophistication and scale for it to then be profitable.
And in terms of what's required, how should a business owner fund their growth? Because my sense is it's easier to fund it by pulling the sales lever, because you think, sales will fund it and then I'll build what I need beyond that.
Yeah.
But we're talking about doing it slightly in the reverse or in a more incremental way. I mean, is there any right or wrong answer between, using earnings to fund it, existing earnings, debt, other investors? I mean, what are your thoughts in that area?
There's no, again, it's there's always a bespoke answer to that because, one owner's facts and circumstances at point X is going to be different to the next person and so on. And so they might have capital themselves privately that they're willing to inject, or they might be in an industry where banks are more comfortable to support. So stock-based businesses, asset-based businesses. So
there's an element of security that a bank will look at.
Correct. So they're much happier to fund the working capital of that business because the securitization is easier. There's a bricks and mortar figuratively that they can secure against in a worst case event. So industries will have different outcomes, but I think it's important. Like I've seen plenty of examples in clients where they've overcapitalized through debt primarily, and they don't have the revenue, I guess, or the profit to support that. Yep. And so I think debt's always good to explore, but you've got to do the sums on what's the cost of that capital versus your profit that you're going to achieve and not revenue.
Okay.
And you got to be conservative on that because as you grow, you're going to make mistakes along the way. Probably that means you're not going to be as profitable. So you can't just assume the same margins. So I think doing those sums on a conservative basis is important. When to ensure that you can service the debt and service the cost of capital. Bringing equity partners in, again, it can work, but I think we spoke earlier about that needs to be carefully managed. It's like the mid market it is just tough. It is tough because you're not dealing with a listed or a multinational where you've already got the cost base of people. You've got the infrastructure there already to roll the business forward. Mid market, it's typically the owners that will do it, and they bring the right people at the right times along for the journey. So it's just the dynamics are just so different, and it's just not as easy to bring someone in. You also got to find the right person as well. And I think often in recent times as well, with the economy being quite challenging, is businesses are looking to explore equity options because they're in distress.
Yes.
And finding someone to come into a business and pay an amount of money that's meaningful to the business when it's theoretically not worth anything in the mid-market is so hard. it's so hard to find someone that's willing to take the risk, put enough money on the line to make a material difference, whilst also just not giving away the business. It is so hard to find.
I understand that, and that takes me to valuation and value of business, right?
Yep.
Which we get involved in pretty heavily in our valuation area. But
you do a good job at it, by the way.
We try, but we got to learn something here. Like, what makes a business valuable?
Yeah.
In the journey we're talking about, right?
Yeah.
From your perspective,
Yeah.
what are the things that you think are a good indicator of strong value in business?
I'll start with the usual, but I'll keep it quick. People. So reliance on people, reliance on the owners in particular, and dependency.
Yeah.
The less of that, the better, because again, people can come and go, but there's a process, there's a procedure, there's a way of doing things in place that's easy to replicate and move on as people come in and out.
Yes.
So dependency. I think the revenue mix is also important. So having a lower concentration on particular customers and less reliance on one customer or a large customer. So if that contract falls away, what does that mean for the business?
Yes.
Contracts as well. So giving security of revenue is important.
Yeah.
So use of technology in your business. So how, and that does come back to processes and procedures.
Yeah.
Technology will allow people to come and go in the business and make the process easier. So to what degree do you have that in place? So from an operations perspective, it's simplified and you're maximizing technology.
So it's sort of an enabler.
Yeah, correct. Yeah. But also then gives you the reporting, the data that you need to make some good decisions at the front end.
Yeah.
I think industry specific as well. There's more appetite in certain types of industries at the moment. Construction's a tough one at the moment.
It is.
Where people are very hesitant to get involved with. And also industry based is what are the barriers to entry for competitors? And so if there's the proverbial moat around the business in terms of other, or the industry with other people coming in and entering to take market share, that's going to bode really, really well. So
if you're in business and you're not thinking of selling, should you care about the value of your business?
Yes. It's so funny that, we have conversations with clients that sort of talk to, what's your 5-10 year plan? And they'll say, I want to sell the business in 10 years. And we'll start to say, okay, well, what should we be doing now to get you sale ready to increase the valuation? And what's so it sounds really silly, but they're the things you should be doing anyway to maximize profit.
Yeah, right.
So you actually should just be doing it anyway, and the value of the business will take care of itself.
Yes. Yeah.
It's really simple. I think, all of the things around reporting, technology, people, governance, all of that, if done well, will result in profit.
Yes.
Will result in profit. And I don't need to tell you this because this is your area of expertise, but the more profit or EBITDA that you have and that you achieve consistently over time, it increases your multiple.
Yeah.
And that's your value.
Yeah.
That's your value. So if you're doing that anyway, you can extract dividends, cash out of the business, and increase your value at the same time. So you should just be doing that anyway, focusing on profit, being as profitable as you can be, as efficient as you can be. We'll give you that valuation.
I like that. And, we had a chat recently. I think, I was seeing more and more people sort of use valuation and think about it in running their business to ensure they have got a profitable business.
Yeah.
But it's a bit weird, isn't it? Because most people sort of, they only tend to focus on it in a potential sale.
Yeah.
Yeah.
Process. I think there's value in, deploying people like yourself at various points in their life cycle. You could, I don't see it happen often, but you could use it as a bit of a KPI metric for your staff in terms of, what it's valued at point A through to point Z. Even from an owner's perspective, in sort of zooming right out and looking, particularly as their accountant or advisor, zooming out and looking at their entire position, it's good for them to know in a true sense what their business is worth, to have an external person give them that advice, because then they can make decisions around funding in particular, right? Okay. So if they feel like they've got some equity in this business, it's worth something, can they leverage another asset that they have that's a bit easier to leverage than a business to then support that business's growth further? And they can get comfort that if, mind my French, shit hits the fan, they could just sell that business because it's worth something to fund the debt that they've created to grow it, And at least that way they've got that fallback and they can get comfortable with that decision. So even like evaluation can be helpful from that perspective too.
And I guess in the mid-market it's important because they're largely private businesses.
Yep.
So, unlike the listed sector where you've got, got a regular liquidity to test the market, so to speak.
Yep.
Sustainability of earnings in terms of profit. What are the important factors there in ensuring that the earnings are sustainable moving forward, do you think?
Yeah. I think you got to look at your customer type and make sure that, another sort of thing I say to clients that, the mark of a good business often is the customers that you say no to.
Yeah, right.
And that might be because of poor payment record, or it might be because they're always going to squeeze you on price, or when the market gets tough, they're going to, really stress your relationship with them.
Yes.
So I think, really having the discipline as a business to really question the revenue that you're earning and not just earning it for the sake of it, because you're just going to jeopardize, the profit on that ultimately at some point. So I think looking at your type of revenue, and then, you got a cost, as we've been saying, right? You got people in a cost structure that's going to support that revenue.
Yes.
You've got to make sure that, if it's a certain type of revenue that, for example, is diversified from what you've got, being super clear and confident that the cost structure to support that is going to be profitable.
Yeah. I like that. I think from our perspective in evaluation sense, we sometimes look at the result and we look at the outcome and we say, okay, well, they did sales of, 46 mil and they did profit of, 7 mil.
It's pretty good.
But then, it is. But then we say to ourselves, but was it a quality result?
Yep.
And often we'll say, well, let's look at their forward pipeline. And if there's nothing in their forward pipeline, then the 46 mil, we have to discount that in a way.
Yep.
Because we're saying, well, hold on, is it going to be repeated in the next year?
Yeah.
You know what I mean?
Particularly if they're in a contract-based business where you can have those peaks and troughs.
Yes, that's right.
Yep, totally agree.
Yeah. In the mid-market that you work in businesses going from a few million to 50, 100 million, 200 million, do you often get involved in the succession and preparing the business for sale?
Yep. Yeah, very often. And on a personal level, it is something that I enjoy because, again, the dynamic of that is just so different to getting into the trenches and running a business. You're dealing with people's future, the future of their kids, their livelihood, etc. So I do enjoy the value that can bring. Yes, and again, it is very, very difficult because we work with a lot of family groups that they might be, for example, siblings more than two together in business, or the parents are still involved, and so there is that true family dynamic, and the keys to the castle haven't exactly yet passed over.
Yes.
And what's interesting at the moment in the Australian economy is there's, I think, something stupid like $20 trillion worth of value in businesses and assets that are going to transition from the baby boomers generation to their kids in the next 5 to 10 years.
Wow.
Like a stupid amount of
it's
value.
Amazing, isn't it?
And so that's going to be good for people like me and yourself, or evaluations needed, or tax advice or commercial advice required around how to best do that. But ultimately, it needs to be very, very carefully managed because, again, in my experience from what I've seen, and it's really unfortunate, but money and death combined are a real recipe for family disaster. And I've seen I've got plenty of war stories around, relationships that just no longer exist because of those two things happening at the same time.
How do you avoid that happening?
Documentation.
Okay.
Yep. So we've done a few engagements where we've basically, looked at a family group. They've got business and they've got property typically, particularly, I'm based in Western Sydney. A lot of migrant families, they love bricks and mortar.
Yeah.
And it served them really, really well. So they've got wealth in their property, but they've got an operating business that has cash flowed it. And even as a class of assets, they're both so different. And so what often happens is the family are keen to keep the bricks and mortar for future generations, and they want to sell the business because of the complexities involved in running it and having children and cousins working together to operate that business. It's just not feasible. So the best way to do that is basically, undergo a bit of a journey. It will take time to basically understand what each family member or what each owner wants and what they want for their future kids or and their nieces and nephews even as well, and their siblings. All agree on, what happens at an ownership level. So for example, if, someone passes away, how are we going to deal with that? Are we going to put a buy-sell agreement in place where the person just exits the business or exits the wealth? Where they're paid their market value, but they're no longer involved in the decision making and the ownership of that.
Okay.
Sometimes that's the best approach to take because it just reduces complexity.
Yeah, because they've got maybe different objectives. So
if you think about it, right? Say there's 3 siblings in ownership and business together. One passes, they've got 3 kids. Normally, and let's just say the spouse is also passed, right? The 3 kids, normally it's split evenly, like in a normal, I guess, arrangement. The 3 kids will then step into that role jointly. So then the business has gone from having 3 owners to 5 owners. And they're all at different ages and have different expectations.
Yeah.
So
naturally so, yeah.
Yeah, and that's just got... And often the level of knowledge of the business is very distant to what the uncles and the aunties might have had from the nieces and nephews. So that's got a whole bunch of complexities that need to be worked through. And often the best decision is just to cut it, extract value, and move on.
Yeah.
But documenting it all before things happen is so important, because if there is an argument, you've got something that's clean and black and white. Whereas if it needs to get litigious, you've got the documents to do it, and it just reduces the pain around going through that process at the end.
And are there many business owners with the foresight and maturity to do this, do you think? Or what triggers it?
Yeah.
What triggers it in advance that
Yeah. Normally, something happening is what triggers it. It's very hard to convince people to think about their own mortality.
Yeah, it is, isn't it?
And there's families' mortality around them. And getting them to... Like, we started a lot of journeys and had to stop because it was just too confronting.
Yes.
But I just think it's so important in safeguarding people from one another.
Yes.
And the business from people.
Yeah.
Because the business is probably the cash cow in the family that supports the business, and so people don't stop and realize, well, we need to actually protect the business from ourselves.
It's a living, breathing beast. Like it's as you say, it's contributing to the flow of money. You sort of intimating, nurture it carefully, and think of it ahead of time.
Yep.
Don't leave it till you need to mop up before the funeral, so to speak.
Yeah. And
or after.
Yeah, there's plenty of stories where, businesses have basically ceased operating or have gone down because the shareholders, post the event of someone passing, haven't been able to make it work, or a property portfolio has been significantly diminished because the surviving spouse couldn't come to an agreement with how they were going to operate together, and they've had to basically get trustees involved and have all these costs in the millions of dollars to resolve it. Whereas if that was all documented and agreed upon in writing, you have to go.
You've got a recipe sheet, yeah.
Correct. You have to go by that, and everybody's agreed and happy with it. So documentation's the key.
Yeah, I like that.
But to get to the documentation is a series of conversations and agreements and alignment that needs to happen, and education as well. A lot of people don't know how these things work, so getting them up to speed on it is super important.
There's a real theme, as we've discussed, about and it's often said, I guess, but about being vulnerable as a business owner, isn't there? Or as a senior person in a family business or whatever. Whether it's being vulnerable to employ a key finance person or a management person, and or whether it's losing control, or whether it's being vulnerable to pick someone in the middle of the ranks and let them shine in a broader opportunity and grow in the business, or whether it's vulnerable in terms of confronting your other shareholders and family members about the future plans of the business, regardless of the death of some parties or whatever. So it's a tricky one.
It is.
Hey?
It is. But I think you have to boil it down to the value. I know we're talking a lot about making or creating value, but also now we're talking about protecting value. And if the family, vulnerability, if we don't realize that what we're doing it for is to protect or improve our value, and I think that's the part that gets people over the line. If in the most simplest of senses, right, and you would have seen this, in a sale process, one of the very first documents that the purchaser or their advisors will ask for is show me the shareholders agreement.
Yes.
And that is so important.
Yeah.
That governs how people come in and out of the business and what's the process to that.
Yes.
And that actually enhances value, because what it demonstrates is that the owners have thought about protecting their business and governing for real bad case scenarios.
Yep.
And so they can come into that knowing that these guys know what they're doing, they're getting the right advice around it, and that if something goes wrong, this document already
Governs the process.
And it covers me, it covers them, and it covers the business. Instead of me now needing to, as part of the suite of documents that get prepared in a sale, there's a share sale agreement, there's employment agreements, there's, if there's a finance arrangement, there's securitization agreements, but then you have to do a shareholders agreement as well.
Yeah.
You're not having to do that helps, but it also just demonstrates that these guys know what they're doing, and if they're doing that, they're probably doing other things really, really well.
Yeah, I like that. If I'm contemplating selling my business in the next 5 years and I'm about 80 million turnover, and I've put in place the systems, the business is still reliant on me and my brother as an owner, for instance. But we've got a top management team. They've got profit share incentives.
Okay.
5 years, I'd like to be out, because I think, I want to do other things. When should I get advice on tax? Yesterday. Oh my God. Damn, I missed out.
No, it's not that. Having a conversation with your accountant or advisor about planning for these things, you can never lose anything by doing that, and you can never go backwards. And you only have to gain from doing that, even just in understanding the process around it. So I think it's always important. The tax is the biggest cost in sales transactions. It's definitely their biggest cost, and generally speaking, it is businesses or people's biggest cost in life, tax, right? So I think, it'd be remiss of anyone to not plan for that as the biggest cost, and it's in a transaction that's probably going to be, the most meaningful in your life. So I think, it can never be too early.
Yeah. And in setting up a business, here we are, we've gone back to the startup phase. What sort of advice should I get around structuring that might help me with that tax position down the track?
Yeah. I think tax is just one of the considerations around structuring. Probably the one that I talk to the most, that it just gets forgotten by business owners, or they've not forgotten, they actually just never been advised on it, is asset protection.
Okay.
Particularly in a multifaceted business, or particularly in a family group that has other things apart from the business that need protecting. Yeah. So, something as simple as, how do you own your shares in your business? Do you own them personally, or do you have a trust that might own them to separate the exposure from value? Who are the directors in your business, or is there one director? What is your mechanism to extract value out of the business, to not only, or out of the entity that's trading the business, not only to save on tax, but to actually protect the retained profits made over time in that business?
Okay.
Because at any point, particularly if you're in a riskier industry like construction or food, in food you're only one meal away from a case, and in construction, I think I don't need to talk about the pitfalls around it. Yeah. You've made profit over time. You can lose that in a day if something goes really, really wrong. And so, how can you actually best move wealth around in a tax effective way that's protected from potential creditors in the future? So I think asset protection and structuring of that is probably the first thing I'll talk to clients about. Now, if a client's going to get into a business where it's going to be a couple of $100,000 turnover, and they're just doing it basically as a wage and they're not really looking to scale, then we're having a very different conversation. But when we're talking about a larger business or a typical medium-sized business that is looking to grow and expand and do some things and take some risks along the way, I think asset protection is the first thing I'll talk to, and tax and logistical simplification is probably the next couple of things I'll then talk to as well.
Okay, and I'm sure some of our audience are in that few 100,000 turnover bracket, and they'll be listening to this discussion and thinking, gee, 100 million sales, that's a long way off. How do I get to that? Is that achievable?
Yeah.
I mean, you've knocked around business for a number of years, Luke.
Yeah.
what are the ingredients to get there? Do you think
Yeah.
that it's a bridge too far, or is it in the Australian market, from what you see in the mid market? I
Yeah.
mean, the players that you're dealing with, I guess they were there at some stage, were they?
Yeah, they definitely would have been if they started the business. And a lot of our clients are that first generation of wealth that have created the wealth.
Yeah, right.
As opposed to it being passed to them to continue on with. When I get asked that question, I actually push back the answer to the client.
Yeah.
Because think about it. I guess my service offering or my skill set is in accounting and in tax and giving people, good sound commercial advice. But I'm not good at running a business. I'm not good at, the particular industry or field that you work in. So how can I tell you as a contract baker or a contract manufacturer
Yes.
or as a distributor or as a builder or as a tradesman or as a restaurateur, how can I tell you how to get from one restaurant to 50 or to grow your revenue from 100 grand to 20 mil when you're in the business every day? You know the market better than I do. You know your competitors better than I do. So I would actually try to give the client confidence that they actually have the answers themselves.
Yeah.
They've just got to then, in terms of, what to think about and consider as part of that, I can then support and help and potentially introduce other people that can also support in particular subject matter expertise areas. So I often try to give the client the confidence that they actually have the answers themselves. It's just about teasing it out with them.
You mentioned the C word there, confidence.
Oh, good. I thought it was something else.
Yeah. Well, it could have been, but no. You mentioned the C word, and I think confidence is a key issue, right? And what you've talked about today are a number of elements that, talking about specific business journeys, would be designed to help the client with their decisions by giving them confidence that they've got the data or the evidence or the understanding to make the next step decisions. Because $1 can become $100,000, but it can become $100 million over time if you're prepared to be consistent and have time in the market.
Absolutely. It's just, I think the role that I can play when having those types of conversations is just teasing it out. I won't have the answers, but I can ask the right questions, I guess. Have you considered how did your competitor do it?
Yes.
What's the market? Have you looked into what the market is for that? Locally, globally, nationally. Do you have the current, support base or infrastructure in your business to actually grow, or do you need to hire people along the way? What are your channels to market? Do you need to find the business first and then employ the team and the infrastructure, or vice versa? So I think there's plenty of questions that I can ask to get them thinking about the right things and to get the answers out of whether it makes sense or not for them to really scale up significantly. But I think it'd be irresponsible for almost any particularly financial advisor or accountant to sort of say, I can actually do it for you. I can give you the answer if it's right or not, because I'm not a builder. I'm not a restaurateur.
No, I love that. And you're an accountant, but you're also a people person. I mean, I just want to talk about you and your journey, because you must have a very satisfying role. Like, it's dealing with a market of private business people, but helping them, manage and develop and protect and grow value. Did you ever think you'd be in this spot? You're in a senior pos within a very respected international firm. Did you ever?
No, I fell into it.
Yeah?
Yeah. I was at uni. I was just doing a business degree, and I was with a close friend of mine who was in accounting, and his mother worked in the practice, and got a phone call in my trackies at uni, and he got the phone call, and it was his mum, and his mum said, "Do you want to come and work with us?"
Wow.
I said, I've never thought about accounting. I've sort of always been more of an English person, better with my words than opposed to with my numbers.
Yeah, right.
I always thought I'd get into something like management or marketing and or sports.
Yeah.
And I was just working at a restaurant at the time, so I just thought, you know what, like, why not? So they said, "Do you want to interview?" I said, "Yeah, sure." When? She said, "Why don't you come in now?" I'm like, "My trackies." And anyway, I went and did it and got the job, and I started the following Monday, and I haven't kind of looked back. So I truly fell into it. And even again, like, I've got to be really honest with myself, I fell into KPMG as well.
Really?
I was at a not long after leaving that initial practice, 16 months into the next practice I was at, we were acquired by KPMG.
Right.
So I fell into the world,
the bigger beast.
And there was apprehensions around that. And I think, if you had asked me at the start of my career, would I want to work for a Big Four, I would have said, heck no.
No.
But sort of, and there was apprehension at the time of the merge, but when it happened and in the months after, I was just loving it. And it was because of what you articulated. It was because, the impact that you're having, particularly backed by a firm that has the expertise, the capability, and the people that we have, that are best in breed and best in market. When you go to market with your skill set, with your commercial knowledge, after having some runs on the board with clients and team, you also feel like you're really good at what you do.
Yes.
And the value that you then have as a result of that, and the people that you can bring in to support, that part's really, really satisfying. So for me, two things that really satisfy me in my role, one is making a real difference to privately owned businesses. So it's the shareholder, it's the owner of that business that we're having the impact on, as opposed to say I'm servicing a listed company. You're just having an impact on one person in that listed company's chain,
I get it.
Right?
Yeah, you don't see the shareholders.
Correct.
Really.
Yeah, and then the second thing is just having that sense of, just being good at what you do, and the team that you operate with being leaders in the industry. Like, that gives me a lot of satisfaction.
Yeah.
In the role and in what I get out of it and do every day. So
I love that.
Yeah, that's sort of my story quickly, but
No, I think that's neat.
Yeah.
Right.
But I had a lot of, I think I need to acknowledge, I had a lot of luck along the way and a lot of good people around me along the way to support. And so, I think, sometimes luck can have a bit of a part to play.
Well, it can, but you've got to position yourself in the right spots to take the opportunities. And I guess that's where I want to end on. In terms of opportunities, for a business owner that's going through that transition of growth, to identify a good advisor, a good accountant to work with. I often see it, their anguish and frustration, because for whatever reason they sort of know they've outgrown their existing accounting advisor, but they're not sure what they need.
Yeah.
And they're cautious about, changing, but they know that they're not perhaps, covering all the bases that they might need to as they're growing.
Yeah.
So what would you advise a business owner to look for, in that scenario?
There's a bunch of telltale signs that they're probably not getting the best out of their advisor. And I think this podcast is probably a really good sort of body of work to go. If you haven't spoken to your accountant or an advisor about these types of issues, potentially they might not be fit for purpose for the scale and risk that you're taking on.
Yes.
But some other telltale signs are, are the bank happy with the financials that you're providing? They're constantly asking questions, or are you constantly lodging late? How do you have a really simple shareholding structure, but you have a large business? So, like, do you literally own the shares personally in your name? Do you have other investments in your family group that the ownership structure seems simple to you? They're the types of things that are kind of telltale signs that maybe you're not getting the right advice. Again, you don't know what you don't know, so you kind of think you're plugging along, you're doing well, you're making profit, but all these things around asset protection, around tax, you're probably not an expert in. You don't know if you're exposed or not. You don't know if you're paying too much tax or not. So there are a couple. Like, I think if you're not talking about, or if you're not approaching your accountant or your advisor around, getting support, generally speaking, around growth, even just not specific questions, but general questions. Luke, what do you think I need to be considering when I'm growing this business? I'm growing now. I can see the sales channels coming through.
Should I be buying a business to add on, or should I be investing in more plant and equipment and growing it myself?
If you inherently don't have the confidence to ask your accountant that question, then that's a telltale sign in itself that they're probably not the right fit to grow with you along the way. Even simple stuff like response times on queries, is a telltale sign that maybe they're under-resourced. But I think I would really kind of question you to go, if you're running a larger business, how involved is your accountant or advisor in just general decision making, not every single decision, but on the bigger ticket stuff. Like, are you bouncing stuff off he or her?
Yeah.
And if you're not, that's normally a good sign.
Yeah. Luke, thank you.
Pleasure. Thank you for having me.
Oh no, it's been my pleasure. I think the audience of Let's Talk Business, I've got some real insights and learnings.
I hope so.
And you know, it's a track that many private business owners want to tread. You know, they want to grow the top line, but they want to retain and grow the bottom line as well. And I think we've been able to uncover some of the key elements of success. But people are first. Thanks, Luke.
Mate, thank you so much.
Cheers.
Appreciate it, James.